Can quantum computers kill Bitcoin? That question has wiped $3.8 billion from crypto ETFs in the last month. Today, we're going deep on what's real, what's FUD, and what it means for your money. You're listening to the AIA Uncut podcast, so let's get started.
It is good to be here. And honestly, looking at the charts this morning, I think this conversation is coming not a moment too soon.
Not a moment too soon is a polite way of putting it. It is Tuesday, February 17th, 2026. And if you are checking your portfolio today, you might want to pour a stiff drink first. The market is just bleeding.
It's ugly.
I mean, do you remember October? It wasn't that long ago. Bitcoin hit that all-time high of around $126,000.
It felt like the party was never going to end.
Exactly. Champagne, Lambos, the whole nine yards. And now we are clawing, desperately to hold on to the $69,000 range.
It is nearly a 50% haircut in, 4 months?
4 months. And usually when we see a crash like this, we can point to a villain. We can say the Fed hiked rates or Exchange X turned out to be a fraud, but this time feels different.
It does.
The fear isn't about the price action itself.
No, it's not about the price, it's about the plumbing. For the first time in maybe a decade, institutional investors are asking a really fundamental question.
Which is
Bitcoin's security model expiring?
Right. We aren't talking about number go down. We are talking about, does the lock on the vault actually work anymore? So, okay, before we get into the sci-fi stuff, let's just look at the body count, because the money leaving the room is staggering.
It's a mass exodus. We've seen $3.8 billion pulled from crypto ETFs in 4 consecutive weeks.
4 weeks in a row.
That data ends just last Friday, February 13th.
And to be clear, that isn't retail traders panic selling $500 on their phones.
No, this is institutional. This is the big money.
This is capital rushing for the door.
Correct. Total assets under management in these ETFs. They've dropped from their peak of about $115 billion.
Wow.
Down to roughly $83 billion. And the sentiment metrics are just perfectly matching that flow.
What's the fear and greed index saying?
It's sitting at a 12. That's extreme fear.
Wow.
It actually hit an all-time low of 5 recently. We are seeing levels of panic we haven't seen since the FTX collapse.
That's incredible.
And get this, if Bitcoin closes this month in the red, which, it looks likely 2026 will be the first year in Bitcoin's entire 17-year history where both January and February were red months.
That is a grim stat. But here's where I want to push on this. Markets don't just panic for no reason. There had to be a specific catalyst, right? This wasn't just a vibe shift. One guy, one report, it seems, tipped the first domino.
That's right, Christopher Wood.
So for the listener who doesn't track every single equity strategist on Wall Street, who is he?
He is the global head of equity strategy at Jefferies. He runs a very famous model portfolio. It's called Greed and Fear. And for years, he's been a massive advocate for crypto. He's had a 10% allocation to Bitcoin in that portfolio. He was one of those early institutional bulls who sort of gave other traditional finance guys permission to buy.
And he bailed.
Completely. He removed the entire 10% Bitcoin allocation, and the tell is where he put the money.
Right. Where did it go?
He moved 5% into physical gold and 5% into gold miners.
That is a statement. That is taking your ball and going home to the 19th century. Why specifically did he do it? Did he give a reason?
He did. He cited existential risk from quantum computing. His argument is that the whole store of value thesis,
the digital gold idea,
that's broken if the underlying cryptography can be cracked. If you can't trust the math, you can't trust the asset.
And clearly people are listening. You've got Mike McGlone from Bloomberg throwing around numbers like $10,000 BTC.
He's calling it an imploding bubble.
Yeah, it's aggressive.
It is, but we are seeing what analysts are now calling a quantum discount. For the first time in 12 years, Bitcoin's uptrend against gold has actually broken. The market is starting to price in a technological death sentence.
Okay, so let's unpack this, because quantum computing sounds like something from a Marvel movie. We need to understand the mechanics here to know if Wood is a visionary or if he's just panic selling the bottom.
Right.
So how does a super fast computer actually steal Bitcoin? I have a password, I have a seed phrase, it's not on a central server, how do they get in?
Right. Let's strip away the jargon. At its core, Bitcoin uses something called elliptic curve cryptography, or ECDSA. Think of it like a very complex math puzzle that involves points on a curve.
Okay.
You have a private key, which is your secret password.
Okay.
And from that, you generate a public key. That's like your mailing address that you give out to receive money.
Simple enough. private key is the key to my mailbox. Public key is the slot on the front where the mail goes in.
Exactly. Now, the math relied on what we call a trapdoor function. With classical computers, the laptop you're using right now, or even the biggest supercomputer at NASA, it's very easy to go one way.
You can make the public key from the private key.
Simple multiplication. But you can't go backward, trying to figure out the private key just by looking at the public key. For a classical computer, it involves brute forcing so many possibilities that it would take billions of years.
Billions.
Billions with a B. The universe would end before you cracked a single wallet.
So the lock is secure because the math is too hard to reverse.
For a classical computer, yes. But here's the problem. Quantum computers don't just calculate faster. They calculate differently. There's a specific mathematical shortcut called Shor's algorithm.
I've heard of this. This is the God mode cheat code for encryption, right?
Essentially, yeah. A classical computer has to try every key one by one. A quantum computer, using superposition, can essentially find the pattern in the math much more efficiently. It allows a sufficiently powerful quantum computer, what we call a CRQC, to solve that impossible backward math puzzle.
And it doesn't take billions of years.
Oh, no. It takes hours.
Yeah.
Maybe minutes.
So if I have a quantum computer and I can see your public key on the blockchain, I can run this algorithm, find out your private key, and boom, I'm you. I can sign a transaction and empty your wallet.
That is the attack vector. But, and this is a huge but, it's important to distinguish between two types of risk here, because not every Bitcoin address is equally vulnerable.
Okay.
There's what we call short exposure and long exposure.
Explain the difference.
Short exposure is when you send a transaction. When you broadcast that transaction, your public key is visible to the network for about 10 minutes, until it gets mined into a block.
So it's a small window.
A tiny window.
Well,
and attacking that is incredibly hard because the attacker has to be faster than the entire Bitcoin network.
Okay, so that's the Mission Impossible heist. You have to intercept the armored truck while it's moving. What's long exposure?
Long exposure is the real problem. These are public keys that are visible on the blockchain forever. They are just sitting there, exposed, 24/7. If a quantum computer comes online, it has all the time in the world to crack those specific locks.
Wait, I thought public keys were always visible. That's why they're public.
Not exactly.
Yeah.
In modern Bitcoin addresses, the address you see is actually a hash of the public key. The real public key isn't revealed until you spend the money. But in the early days, things were different.
And this leads us directly to the nightmare scenario that Willy Woo was analyzing just a couple of days ago, because apparently there are a lot of these exposed keys just sitting around.
There are, and this is where the economics get really scary. Willy Woo's analysis from February 15th points out there are approximately 4 million Bitcoin sitting in old wallets.
4 million.
Mostly from the Satoshi era, or these early PTPK, pay-to-public key addresses. In those early wallets, the public key was just put right there on the blockchain. It wasn't hashed.
So those 4 million coins are sitting behind a lock that Shor's algorithm can pick.
That's the threat.
For years, we thought of these coins as lost. We just assumed the owners lost their keys, threw away hard drives. We treated them as if they didn't exist, which actually helped the scarcity story.
Right. Lost coins are a donation to everyone else.
Oh.
That's the saying. It makes the remaining coins more valuable. But if a quantum computer works...
Then they aren't lost. They are zombie coins.
Exactly. They rise from the dead. If a hacker or maybe a rogue nation state cracks those keys, they get access to 4 million Bitcoin instantly.
My God, that dumps 8 years of corporate accumulation onto the market in a single day.
It's a supply shock that would, you're right, it would zero the price. And it creates a massive crisis of confidence.
Yeah.
The scarcity narrative, the idea that there will only ever be 21 million coins, it dies immediately.
But hold on. If that happens, does the network just stand by and watch? Can't we just update the software, freeze the funds?
This is the governance dilemma. And honestly, it is arguably scarier than the hack itself. The Bitcoin network would face an impossible choice. Option A is a hard fork. The community agrees to rewrite history and freeze those stolen coins.
But that breaks the golden rule. Code is law. If you freeze those coins, you are saying Bitcoin isn't immutable. You're saying we can censor transactions if we don't like who owns them.
Precisely. It destroys the entire ethos of Bitcoin. It becomes just another database managed by humans who decide who's good and who's bad.
Okay, so what's option B?
You don't freeze them. You stick to your principles. Code is law. The hackers sell 4 million BTC, the price crashes to zero, and all trust in the system just evaporates.
It's a lose-lose. You either kill the price or you kill the philosophy.
And Willy Woo estimates there is a 75% probability that the network would not be able to agree on a freeze. It's just too contentious. The miners, the nodes, the purists, they would fight. Which means, in his view, the most likely outcome is a massive flood of supply.
Okay, I'm sufficiently terrified. I'm looking at the sell button right now. Christopher Wood is looking pretty smart, but let's take a breath. Is this happening tomorrow?
No.
Is there a quantum computer in a basement somewhere that can do this?
No. And this is the reality check part of our deep dive. We need to separate the theoretical panic from the engineering
Yes,
reality.
I do, because my heart rate is up.
Right now, the most advanced quantum machines, like Google's Willow chip, are impressive, but they are noisy and unstable. They are thousands of logical qubits short of what's needed to run Shor's algorithm on Bitcoin's encryption.
So we're talking about a water pistol versus a tank right now?
Precisely. The industry consensus places a cryptographically relevant quantum computer, a CRQC, about 10 to 20 years away. We're looking at 2035 or later.
Okay, so Christopher Wood sold his Bitcoin because of something that might happen in 2035. That seems premature.
That is the argument. And there is another data point here that counters the doom narrative. CoinShares put out a report that pushes back hard on that 4 million lost coins figure.
How so? If the keys are exposed, they're exposed, right?
Yes, the keys are exposed. But CoinShares argues that while many addresses are exposed, most of them contain dust-tiny amounts of BTC that just aren't worth the cost to hack.
Right. Running a quantum computer must be incredibly expensive.
Exactly. You aren't going to burn millions in energy to crack a wallet with $50 in it. They estimate that only about 10,230 Bitcoin are held in large, high-value clusters that are actually vulnerable and worth the effort.
10,000 is a hell of a lot less than 4 million.
It is a manageable risk versus an existential one. 10,000 BTC is a bad Tuesday on the markets, not a death spiral.
And we should also look at who's holding the bag today. It's not just sleepy Satoshi wallets. MicroStrategy, the biggest corporate holder, they addressed this on their earnings call just last week.
They did, and their team explicitly stated that quantum computing is not an imminent threat. They hold over 190,000 BTC. They estimate only about 1.4% of their holdings are even theoretically at risk.
Why so low?
Because they use modern safe addresses. They aren't using those old P2PK wallets. They use addresses where the public key is hashed until the moment of spending.
So if you're using a modern wallet and you haven't reused your address, your public key isn't exposed.
Right. You're only vulnerable during that short exposure 10-minute window. And cracking a key in 10 minutes, that requires a quantum computer so powerful we can't even theoretically design it yet.
Okay, so the zombie coin apocalypse might be overstated, but still, 10, 15 years, that goes by fast. Is Bitcoin just sitting there waiting to die? Or are they doing something about it?
This is the part of the story that isn't getting the headlines, but is the most important. Bitcoin is fighting back. The immune system is kicking in.
Enter the engineers.
Exactly. Just days ago, on February 11th, a major proposal was merged into the official Bitcoin repository. It's called BIP 360.
BIP 360, what does it do?
It introduces a new output type called P2MR, or paid Merkle root. Now, without getting too bogged down in the code, think of this as a quantum-resistant vault. It uses a new type of cryptography called MLDSA.
What's that?
It was formerly known as dilithium.
Dilithium, like from Star Trek.
The very same. But in our world, it's a post-quantum cryptography algorithm that has been standardized by NIST. It's designed specifically to withstand Shor's algorithm. It uses a different kind of math that quantum computers really struggle with.
So it's a shield.
It's more like a fire escape. BIP 360 provides a migration path. It means if you own those old, vulnerable coins, you will have a way to move your Bitcoin into these new quantum-proof addresses. They'll start with BC1Z.
So before the quantum computers get powerful enough to crack the safe, we're building a new, stronger safe and giving everyone the combination.
Exactly. And the testing is already happening. The first Bitcoin quantum testnets were running back in January. The engineers are building the shield before the sword is even forged.
That makes me feel better. It's not just a sitting duck. But I want to zoom out for a second. If a quantum computer can break Bitcoin's encryption, what else uses that same encryption?
Everything. And this is the point that the COO of Function Space made, which I think puts this all into perspective. Bitcoin uses elliptic curve cryptography, But so does your bank. So does the military. So does the little HTTPS lock icon on your web browser.
So if they can crack Bitcoin...
If a computer exists tomorrow that can drain a Bitcoin wallet, it can also drain your JP Morgan account, it can decrypt nuclear launch codes, it can read every encrypted email ever sent.
So if Bitcoin goes to zero because of quantum, the price of Bitcoin is probably the least of my worries.
Precisely. If that level of encryption breaking happens without a fix, the US dollar collapses, the stock market collapses. It is a civilization-level event, not a crypto problem.
That is oddly comforting in a we're all doomed together kind of way.
It just means the entire world has an incentive to fix this. And they are. NIST finalized their post-quantum standards back in 2024. Google, IBM, Microsoft, the US government, they are all upgrading their systems right now. Bitcoin is just part of that global upgrade cycle.
So Bitcoin isn't alone on an island. It's in the same boat as the rest of the digital world.
It is. And if you look at history, Bitcoin has been declared dead hundreds of times. The China ban, Mt. Gox, FTX. Every time the narrative was, this is the end.
And every time it was just an engineering challenge or a market flush.
Exactly. This is an engineering challenge. It is a difficult one, yes.
Yeah.
It requires consensus and upgrades, but it is not a funeral.
So let's bring this back to the listener. We've had a month of sheer panic. $3.8 billion out the door. People selling at a loss because they think the sky is falling.
The panic is real. The losses are real. But the threat itself is theoretical and distant. The technology to break Bitcoin doesn't exist yet, and the fix to save it BIP 360 is already being coded.
It sounds like the market is pricing in a doomsday scenario that is highly unlikely to play out the way the fearmongers say it will.
I think that's a fair assessment, but it does leave us with a provocative thought, one that I can't quite shake.
What's that?
For a decade, the pitch for Bitcoin has been digital gold. The idea that it's static, unchanging, perfect money. You buy it, you hold it, it's a rock.
Right. Rocks don't need software updates. Gold doesn't need a fork.
So Bitcoin does need updates. To survive the quantum era, Bitcoin has to change. It has to implement BIP 360. It has to evolve. It essentially has to admit that it's software, not a rock.
That cuts deep. If I have to keep moving my gold to a new vault every 20 years to keep it safe from new technology, is it really gold? Or is it just a tech platform?
Exactly. Bitcoin is shifting from being viewed as a static asset to a living tech platform that must upgrade to survive. Whether the institutional investors, the ones who want digital gold, are comfortable with that shift, that is the billion-dollar question.
And one we will probably be debating for the next 10 years. We're going to leave it there. Thanks for diving deep with us today.
Always a pleasure.
And to you listening, don't panic, check your sources, and maybe keep an eye on those BC1Z addresses. We'll catch you on the next deep dive.